Welcome. Today we're diving into how changes in a partnership affect tax under Malaysian law. Unlike companies, partnerships in Malaysia are not taxed as separate entities. Instead, each partner is taxed individually based on their share of the business income. This means that whenever the partnership's composition changes, whether a new partner joins, someone retires, passes away, or the partnership dissolves, the way profits, losses, and taxable income are allocated must be adjusted. Understanding these rules is crucial for accurate tax computation and compliance with the Income Tax Act 1967. Let's explore the different scenarios and their tax implications. Changes in a partnership's composition can significantly impact how profits and losses are shared among partners. For tax purposes, it's not just about who's in the partnership, but also when they joined or left and how the profit-sharing ratios are set. These changes determine each partner's taxable income for the year. If not handled correctly, it could lead to errors in tax reporting or even penalties. That's why it's essential to understand the rules and keep proper documentation. Let's look at the main types of changes that can occur in a partnership. A new partner joins a partnership during the year. The partnership's income for that year must be split between the old and new partners. This split is based on the date the new partner joins and the profit-sharing ratio agreed in the partnership deed. For example, if a new partner comes in halfway through the year, the profits earned before and after their admission are allocated differently. This ensures that each partner is taxed only on the income earned during their period of participation. Let's see how this works in practice. Imagine a partnership with a yearly profit of Rm 120,000. Two partners A and B share profits equally. On July 1st, partner C joins. For the first half of the year, A and B each get Rm 30,000. For the second half, profits are split. A and B each get 40% and C gets 20%. That means from July to December, A and B each receive Rm 24,000 and C receives Rm 12,000. Each partner then reports their share in their personal tax return. This method ensures fairness and compliance with tax laws. When a partner retires during the year, the partnership's profit must be apportioned between the retiring partner and those who remain. The split is based on the date of retirement and the profit-sharing ratio. Importantly, any retirement payments, such as for capital or goodwill, do not reduce the partnership's taxable income unless they qualify as allowable business expenses. This ensures that only the actual share of profits is taxed, not the retirement benefit. Let's see how this affects the remaining partners and the retired partner. A partner passes away, their share of profits up to the date of death is taxable in their estate. The partnership continues with the surviving partners, who then share future profits according to a revised profit-sharing ratio. Income earned after the date of death is allocated only to the surviving partners. This approach ensures that the deceased partner's estate is taxed fairly, and the ongoing partnership remains compliant with tax regulation. Proper record-keeping is essential in these situations. Sometimes, the partnership agreement is amended to change the profit-sharing ratios among partners. When this happens, the divisible income for the year is reallocated according to the new ratios. The new ratios are applied pro rata, based on the effective dates of the changes. This ensures that each partner's taxable income reflects their actual share during the relevant periods. Accurate records of these changes are vital for correct tax reporting and compliance. When a partnership dissolves, it ceases to exist as a business entity. Final accounts are prepared, and the adjusted and divisible income is computed for the period up to dissolution. Each partner is taxed individually on their share of profits up to the dissolution date. If assets are sold or disposed of, balancing charges or allowances may arise, affecting the final tax position. This process ensures that all income is properly accounted for, even as the partnership ends. Key principle in partnership tax is the apportionment of income. Provisional adjusted income, PAI, or divisible income, DI, must be split based on each partner's time of participation and the relevant profit-sharing ratio. This ensures that each partner is taxed only on the income they actually earned during their time in the partnership. It's a fair and logical approach that aligns with the Income Tax Act's requirements. Payments made to retiring partners or to the estate of a deceased partner, such as for goodwill or retirement, generally do not reduce the partnership's taxable income. The only exception is if these payments are specifically allowed as business expenses under the Income Tax Act 1967. This rule ensures that only legitimate business expenses affect the taxable income, maintaining fairness and compliance. When a new partner joins and contributes capital to the partnership, this capital contribution does not affect the partnership's taxable income. Only the share of profits allocated to each partner is relevant for tax purposes. This distinction is important because it separates business income from capital inflows, ensuring that only actual earnings are taxed. Whenever there's a change in partnership composition, adjustments must be made to the capital accounts, partners' drawings, and retained profits. These accounting entries ensure that each partner's financial position is accurately reflected and that the partnership's records remain up to date. Proper adjustments are essential for both tax compliance and internal management. Accurate documentation in the partnership deed and accounts is crucial. It ensures that all changes, whether in partners, profit-sharing ratios, or capital contributions, are properly recorded. This not only supports correct tax computation but also protects the partnership in case of disputes or audits. Good records are the foundation of compliance and transparency. Let's revisit the earlier example. With a profit of Rm 120,000, partners A and B share equally until partner C joins on July 1st. For the first half, A and B each get Rm 30,000. For the second half, A and B each get Rm 24,000, and C gets Rm 12,000. This split ensures that each partner's tax liability matches their actual participation in the business, reflecting the core principle of fair apportionment. If a partner retires mid-year, profits are split based on the date of retirement. The retiring partner is taxed only on their share up to that date, while the remaining partners are taxed on the rest. Retirement payments, unless specifically allowed, do not reduce the partnership's taxable income. This approach ensures clarity and fairness in tax reporting. When a partner passes away, their share of profits up to the date of death is taxed in their estate. The surviving partners then share future profits according to a new ratio. This ensures that the deceased's estate is taxed fairly and the partnership continues smoothly with updated records and ratios. Upon dissolution, the partnership prepares final accounts and computes income up to the dissolution date. Each partner is taxed on their share, and any asset sales may result in balancing charges or allowances. This process ensures that all tax obligations are met before the partnership formally ends. Critical takeaway is that any change in partnership composition requires a pro rata allocation of income. This means each partner is taxed only for the period they participated in the business. It's a fair system that matches tax liability to actual involvement, preventing over or undertaxation. Another important point is that capital contributions and retirement payments usually do not affect taxable income. Only the share of profits matters for tax purposes. This distinction keeps the focus on actual business earnings, not capital movements or retirement benefits. Proper documentation in the partnership deed and accounts is essential for accurate tax reporting. Keeping detailed records of all changes, admissions, retirements, deaths, and profit-sharing adjustments ensures compliance and protects the partnership in case of audits or disputes. Summary: changes in a partnership, whether through new admissions, retirements, deaths, or dissolution, require careful allocation of profits and losses for tax purposes. The key is to allocate income pro rata, keep accurate records, and understand that only profit shares are taxed, not capital contributions or retirement payments. By following these principles, partnerships can ensure compliance with Malaysian tax law and avoid unnecessary complication. Thanks for watching, and stay informed for better business decisions.